Trading is only difficult because you are overthinking it. Let's begin with this video. Essentially, in terms of technical analysis, all you are doing is trying to determine a higher time frame bias or direction, whether that's bullish or bearish. Once you've identified that bullish or bearish direction, let's say here you had a bullish direction, right? You are simply looking for key levels on the higher time frame direction which supports that higher time frame bullish idea in this scenario. That could be your imbalances, your old lows, liquidity sweeps, order blocks, etc. But essentially, once you've identified the key levels that support your higher time frame bullish direction to go higher, all you are simply doing is you dropping down onto a lower time frame, look for that realignment for your highest probability trades, and then refine your trade entries and setups. That is basically the key idea behind your technical analysis. What makes it difficult for a lot of you is because 1, you lack the ability to stay patient. You lack the ability to wait for that realignment, for example, or that retracement into that key level and then realignment to continue higher. Not only that, but you are looking to trade every single setup that you see, even if it's against your higher time frame direction. Now, this doesn't mean it doesn't work out. You can take counter trend trades, but the thing is, you need to know when to exit out of those counter trend trades before you realign yourself to go pro trend again. Simply put, your job as a trader is to wait for your highest probability setup. You don't have to trade every single day or take every single setup you see, and that will still make you a successful trader. So with that in mind, let's begin with our top-down analysis. Here, on the monthly time frame, it's extremely clear that we are in a bearish scenario. Lower highs, lower lows, lower highs, and lower lows. So here, you would anticipate for price to retrace back into one of your key premium array levels on your monthly time frame to implement a lower high before implementing a lower low. That is your basic market structure in a bearish scenario. You can see here, because price can't just always expand in one go. It always has to retrace, accumulate more orders, engineer more liquidity, for example below here, before it distributes lower in your higher time frame bearish direction and takes out any resting liquidity. So here you can see that we have already had a bearish market structure break on your monthly time frame. So this is your realignment off of this bearish order block that we can anticipate for price to continue lower now. So with that in mind, your monthly direction is bearish. You had your market structure break here, which confirms that this retracement is likely going to come to an end. This is where you would drill down to the daily. Look at the retracement into your monthly rejection block. The retracement into this monthly rejection block, look at what it created on the daily. Steady bullish order flow. Look at these lows. They all become your low resistance sell side liquidity in the form of your trendline liquidity and your relatively equal lows. Look at how at every significant swing low, so if I zoom closer, look at every significant swing low. This one, and this one. They don't take out the previous swing low. So all it is doing here is just building up a large pool of liquidity in the form of your sell side liquidity for price to eventually attack once it gives you that bearish confirmation on the daily off of this monthly rejection block and distributing it lower. So when it attacks these sell side liquidity, this is where the markets could pair up their short positions with the sell side liquidity to distribute price lower. So let's continue playing price out and see if it gives us that bearish realignment. And it does so. Here, it gives you an extremely strong bearish reaction off of this monthly rejection block. So that's your first telltale sign that we are likely going to have a market reversal from here. Especially after disrespecting discount arrays, and price comes back, respects this premium array, and it gives you another break lower. So that is your market structure shift confirmed with the respect of premium arrays and disrespect of discount arrays. So here, that is your higher time frame direction confirmed. All we simply done was determine your monthly bias, which is bearish, right? It came back into this bearish order block and it gives you a market structure break. Price retraces back into this premium array. Because the monthly gave you a market structure break off of this key bearish order block level, you are anticipating for this rejection block to stay protected. If it gets disrespected and takes out this low, this is where you can anticipate price to go higher. But it doesn't. So you are anticipating to see a bearish reaction off of this rejection block. If you draw down to the daily, this is where you had that bearish reaction. So that confirms that this monthly bearish rejection block is a valid key level to hold price action to continue lower. And then when you draw that onto your daily time frame, you get more confluences. These resting sell-side liquidity. They are not random liquidity. They are simply engineered for the future anticipated bearish distribution, because your monthly time frame, like I said, is in a bearish bias. As you can see, if you continue to play price out, your daily is coming back to key premium array levels, respecting them before distributing lower. And that's the easiest yet most simple way to determine your higher time frame direction. What arrays are being disrespected and respected, whether that's premium arrays are being disrespected and discount arrays being respected in a bullish scenario, or premium arrays being respected and discount arrays being disrespected in a bearish scenario. So here, we are getting disrespect of discount arrays and respect of premium arrays. So that shows you that your daily time frame has now realigned with your monthly bearish bias off of this monthly key level. Right, let's keep playing price out and see what it does on the daily time frame. Comes back into this order block and it distributes lower, taking out this old low. And as you can see here, this is where you had your market structure break on the daily time frame. But this is the key thing here. Even though you had a bullish market structure break here, are you anticipating for this to be your next drawn liquidity? No, you are not. Simply because your monthly is bearish, and this high here is a very significant swing point. You do not want to see that get violated. If it gets violated, that would mean your bearish market structure on the monthly time frame is invalid and you're likely going to continue higher. So because we're anticipating for the monthly to continue bearish, you want to see that swing high stay protected. And this bullish market structure break shouldn't throw you off, because if you go into the weekly, this steady bearish order flow, this price action here, all the way down to here, on the weekly, that is just one large expansion. And you know that price is fractal. So this bullish market structure could just be to retrace back into either weekly key level or sweep daily buy-side liquidities to accumulate more positions before distributing it lower. Because price can't just expand in one go. It's the same for every single time frame. Even on the weekly, it can't just expand all in one go. Right? Look at this. On the weekly here, that was just one expansion and it leaves behind a lot of imbalances and premium arrays that price has to come back into and accumulate more positions before distributing it lower. And as you can see, if I keep playing price out, price comes back into this bearish order block. Even though on the daily, that is clear bullish market structure break. That bullish market structure break was valid. And this is where you get your bullish order flow. On the weekly, that is just a retracement into this bearish order block. So that is something you guys need to be wary of. Higher time frame direction in general, relative to the time frame you're on, is always key. So if you was on a weekly, always be aware of the monthly time frame. If you was on a daily, always be aware of the weekly time frame. Vice versa as you go down. Hourly, always be aware of the 4 hour. 4 hour, always be aware of the daily, etc. Right, so when price comes back into this weekly bearish order block, drop down to the daily, look for the same thing. Look for the realignment to determine that this weekly bearish order block was a valid weekly key level. But you could already start to anticipate that we could get a bearish reaction off of this because your monthly is bearish and the weekly is bearish. So yeah, that is exactly what you get there. Swing low gets implemented, displacement through. That is your market structure shift. So now the daily has been realigned bearish. All you had to do was wait for price to come back into this weekly high time frame premium array. Look for that retracement to realign with your bearish order flow. And this is where you can look for shorts again, your high probability shorts. But this doesn't mean that in this segment in price, you can't catch the long after you had this market structure break. Once you had this market structure break, jump up. Be aware of what key levels there are that price could possibly have a reaction off of. And that could be your short-term temporary targets if you was looking to long into those areas. But again, like I said, because your higher time frame direction, because your monthly time frame direction is clearly bearish, you are not looking for the significant high to be your overall drawn liquidity when you are looking for longs here, because the longs are opposing your higher time frame bearish direction. So when you look for longs, keep your targets short term and only long into your key levels where you are anticipating for price to possibly have a realignment off of. And that works the same way if you was in a bullish higher time frame direction. When you are in a bullish higher time frame direction, and you draw down time frames, only shorts into key higher time frame discount levels, because you are anticipating for price to respect those before continuing higher, since your overall time frame is bullish. So, back to this top-down analysis. You have this bearish market structure break. Again, respect of premium arrays, disrespect of discount arrays. Because you had a realignment, what now becomes your draws on liquidity? This sell-side liquidity, before eventually this overall sell-side liquidity. The reason why this is a valid sell-side liquidity draw, even though it's at the extreme of the range, in comparison to this buy-side liquidity draw, is because you have your higher time frame bearish direction supporting it. Price comes back into this imbalance. Now, this is where you can start to drop down onto your execution and intermediate time frames. Price is fractals, so the same thing you've done on your monthly and your higher time frame, you would do for the same thing on the daily and your intermediate time frames. So, the daily, bearish, it comes back into a key daily premium array level, and you have these sell-side liquidity draws. This is where I would draw down onto the hourly. And again, look for that realignment to go bearish to show you that it's respecting this daily premium array level. But you're already anticipating for this daily premium array level to stay respected, because the daily is bearish. So, when the hourly gives you that bearish market structure break, which is already what you had here with heavy displacement, that is going to be an extremely high probability trade. Because now, your hourly, your daily, and your higher time frame is all aligned to go bearish. And it's simply just rinse and repeat. Here you have this imbalance. When price retraces back into that imbalance, you could drop down onto the 5-minute and look for the exact same thing. Here, you had the sweep and it takes out this swing low. So that becomes your market structure break. Price then retraces back into this imbalance. And this is literally where your entry could be. Stop loss is above there. And you could go for this immediate draw on liquidity for a nice 2.35 hour trade. So if you keep playing price out, it took some time, but that's exactly what it does. If you look at another example here, so once we took out that sell-side liquidity draw, you can anticipate for price to retrace. Right now it's just consolidating around this area. Price comes up, has a strong wick, sweeping this buy-side liquidity. But look at the wick and the body. Strong wick above it, but the body closes with an extremely aggressive upper wick back within the range. So that shows you that that is a very valid sweep. All it is doing here is that it's showing you that it's still respecting this higher time frame being your daily premium array. And all it done here will sweep this buy-side liquidity. So if you drop down to the 5-minute, you can see that that heavy displacement lower is your change in state of delivery. It's disrespecting multiple up-close candles and imbalances, with heavy displacement off of this key premium array level. So that shows you willingness to continue lower. This is where you could have another trade. You could refine this, drawing out your range, refine it to the key levels that is within that range. So here, you could use this as an inversion level, in the premium of that range, entry here, stop loss of above there. What would your target be? The new immediate drawn liquidity being here, right? So, playing price out, tags you in, and it gives you heavy displacement lower. So all of this price action here, even though it shows you aggressive bullish price action on a lower time frame, you shouldn't be bothered by it, because on the daily, the hourly, and your monthly is showing clear bearish price action. It's showing respect of clear premium arrays and disrespect of discount arrays. When it gives you bullish price action in that scenario, all it is simply doing is retracing back into these key levels, accumulating more positions before distributing it lower. And that is why you shouldn't overthink trading. To reiterate, your higher time frame direction is always key. Your lower time frame direction will tell you nothing. All you are using your lower time frame direction to do is refine your entries. And depending on the way you trade, the majority of you are going to be intraday traders or scalpers. You are simply just using it to be in and out of trades very quickly. But without your higher time frame direction, you would just constantly be muddled up with your lower time frame direction. And that is where you start to overthink. Because when you have your lower time frame, for example here, look at the amount of times it went from bearish to bullish to bearish. you would constantly be stuck between conflicting biases and start to overthink and question what the true bias is. Right, but after watching this video, you know that your true bias always lies in your higher time frame direction. Any bullish price action on the lower time frame is simply just a retracement into your higher time frame key levels before distribution lower, because your higher time frame direction is bearish. So that's the key lesson for this video. You guys are simply overcomplicating your trading because 1, you are too glued to the lower time frame. You are unaware of what your higher time frame direction is currently telling you. 2, you are too impatient to wait for those signs that the price is going to reverse or respect certain key levels. And 3, you are trying to trade every single setup that you see. Going back to this point, 5 minute. You can take trades every time price gives you a market structure break on your lower time frame, but in the long run, it is not sustainable because you're constantly trying to catch 2 directions in the markets, right? And it becomes not only challenging, but it also takes a toll on your mental state. All you need is one good trade, and not only is that good for your mental state in trading, but also in the long run, it helps you preserve your capital more. And that should be your number 1 priority if you want to stay in this trading game for long. So, don't overthink trading. All you're doing is determining your higher time frame bias and then dropping down time frames to refine your entries and trade setups in line with your higher time frame bias. And that pretty much concludes this video. I hope you guys found this video helpful. If you did, please like and subscribe. If you have any questions or suggestions for future videos, please leave them below in the comments. And like always, take care and I'll see you guys in the next one.